80% of advisors' clients in a survey said that they did not feel that their advisor knew them and that they had no loyalty to that advisor.
Thank you for joining us today on the Land and Everything Else podcast. I'm Dr. Craig Lemoyne, and I'm joined by a really exciting guest today, Shana Orczyk Sissel, the Queen of Alts, I've been told to call you.
Oh.
And Banríon Capital Management CEO, and really an incredible, well-known person in the alt space and Investopedia alt space, wealth management alt space, all sorts of exciting media and news promotions. And thank you for joining us today. We're so excited to have you.
No problem. I wear that title proudly, but I don't require people call me the Queen of Alts.
I mean, I would.
All right.
I would immediately upon walking in a room.
All right.
If I was in your shoes. But
maybe I'll take on that.
Well, thank you for joining us. One of the things we've been talking about, and I would love to get your perspectives on this podcast, if we go back 40 years, right, we see real estate and agriculture assets held, private equity in institutional portfolios, right? We see insurance company reserve funds, we see state pension funds, we see alts living primarily in that institutional space. But as technology is scaled and we've been able to see that trickle to the family office space and the RIA space, I know you're an absolute expert in that connection tangent world. I was wondering if you could share with me your perspective on as alts have gotten more plentiful in the RIA market and kind of how you've seen that journey happen.
Yeah, so plentiful in the RIA market in terms of ability to access.
Yes.
I would suggest that actual usage is low.
I would too.
So 70% of financial advisors don't use alts.
Right.
And the average allocation an advisor does have to alternatives, if they use them at all, is somewhere between 5 and 7%. And I've seen upwards of 9. I think that's aggressive. I am inclined to think it's closer to 5. It was 3, like 5 years ago. In general, institutions allocate somewhere between 20 and 35%. And for the ones that don't need liquidity, so endowments specifically, it can be upwards of 80%. And I think that one of the interesting evolutions here is accessibility helps. But it's still been limited because most alternative products have regulatory restrictions on who can invest in them, and you have to meet those hurdles. There are things like qualified purchaser rule, which requires that you have $5 million in liquid net worth. I think that's what it is. And then the accredited investor rule, which is nuanced. It's $2 million in net worth. It doesn't necessarily have to be liquid, or your income exceeded a certain threshold over a period of time. And so traditionally, these structures, because they are private vehicles, they're considered sophisticated.
Sure. And
it's kind of like buyer beware, if you will. The regulators don't want to get too involved. They require these hurdles to ensure that only quote unquote sophisticated investors can invest. So until say 2007, it really was just a space for really ultra high net worth individuals, even if it was an individual. In 2007, the SEC made changes to the Investment Company Act of 1940, which is the act that covers the formation of things like ETFs, mutual funds, closed-end funds, and the like. Registered product that's available to any investor. Though that rule change allowed for mutual funds specifically to use leverage and to short a portion of the net asset value of the fund that was not allowed prior. So at that time, anybody who was around then will recall there was a massive amount of 130-30 and 120-20 and 125-25 funds that came into the market. And so those funds are reflective of the change in the rules. So the max you could short the NAV of a fund was like 30%, which is why everything stopped at 130-30. But those funds aren't really alts. I mean, they're still beta 1. and they're basically shorting as a form of leverage to get more long exposure.
Sure.
And most of them were not great. And I challenge you to go find any existing 130/30 or 120/20 funds. There's maybe 3 or 4 that still exist.
Okay.
But there used to be hundreds. So that opened up the floodgates to bringing alternative products to the market, but mostly things that hedge funds had traditionally done. Long short equity, global macro, managed futures.
Sure.
Big firms like AQR in particular kind of launched a lot of mutual funds at that time that fall into that space. Abbey Capital is another one. There's a number of really big firms that you've heard of that have a nice amount of product in the space. And those firms actually were, in the case of AQR, in the case of Abbey Capital, like hedge funds prior. So they were just bringing products they had already been managing for years and years into a different structure. Then in 2019, the SEC made changes to ETF rules that allowed for active, non-transparent ETFs. And in doing that, that allowed for these same products to now be offered in the structure of an ETF. So that reduced the fees associated with them, made them even more liquid and accessible and easy to trade. So we've seen less mutual funds and a lot more ETFs come to market in the space. And then the final real domino to fall that has really opened accessibility to the average investor is the advent of the interval fund. So the interval fund is a registered product under the 1940 Act, but it is not like a mutual fund or an ETF. It is not daily liquid, but it allows for, because of its structure and it not requiring daily liquidity, it allows for investments in things that are non-liquid, like private equity and private credit and venture capital. There's about a little over 200 interval funds now in existence, and the vast majority are real estate. So 70%. But right now, the trend is that every VC fund on earth is trying to launch a interval fund.
Well, let's pivot on that for a minute.
Okay.
One thing that we're really good at in wealth management, right? We kind of have this idea of CFPs and, you get your 65, maybe you get a CFP, right? We're really good at teaching you about securities, really good about teaching about stocks, bonds, funds, all those sorts of things, right? But alternatives are, in essence, on a CFP study material is about one chapter of an investment book, right? Which is one tiny fraction of the actual curriculum. So as advisors have more opportunities on their custodial platforms, as advisors have more opportunities with different comp models that you see starting to come up a little bit, how do they do diligence? How do they learn? Where have you seen missteps and where have you seen good practices?
So this is actually one of the major hurdles, and that's why 70% of advisors don't use alternatives because they do require substantial diligence, and most advisors don't have the resources. I would argue even the biggest advisors don't have the resources. So, if you're not Morgan Stanley or one of the big broker dealer investment banks that have massive teams in private wealth and prime brokerage and like hundreds of people that's their job. In the wealth management space, even the huge aggregators like the Hightowers and the Dynasties and the Mariners of the world have teams, but not big teams.
Right.
And the way those structures really work is the advisors that work with those firms have some level of independence. But when it comes to these types of products, they are required to kind of get home office approval.
Sure.
So they'll see something, a client will bring something to their attention, and they'll say, oh, cool. And they'll send it to that team of 4 or 5 people at home office and ask for it to be diligenced. Problem is, there's hundreds of thousands of advisors. And so if even half of them have one thing every year, it's an overwhelming amount of requests that they can't keep up with.
Right.
So, there are plenty of firms like my own out there that can do due diligence. There's one out there, I think it's called FactRight, that does mostly real estate and oil and gas due diligence, things that are structured in it's structured in a way where there's a depreciation aspect. And then there's firms like ICAP and CASE that that either provide feeders or do their own due diligence and then make that available to advisors. But ultimately, it's still a limited universe. Most of the bigger players in the space only really pay attention to the biggest firms.
Right.
And I would argue that if these big, huge private equity shops are offering advisors an opportunity to get into something, it's probably because they couldn't get it completely subscribed with institutional money, which is easier. So you're probably not getting the best product. I don't want to say that's true with everyone. I do think that there's firms like Apollo in particular who have a dedicated wealth management group and are dedicated to providing high quality product. But I would argue that some of the others are not. They don't have dedicated wealth management. They don't have dedicated support for advisors. So they rely on folks like ICAP and CASE to kind of act as the intermediary. So advisors really, the piece of advice I would give is you really do need to go find professional help.
Yes.
And there's a lot of different ways to do that. You can hire a consulting firm like Russell or Mercer, both firms of which I've worked for. And you can hire them just to do a due diligence report. It's not cheap.
No, imagine not.
On average, anywhere between $50,000 and up. And also, those firms tend not to work with wealth managers. They're usually hired by pensions,
sure,
endowments.
Institutional endowments,
right, and
so forth.
How you would diligence something for an institutional investor is different than you would for a wealth manager. So I would argue you could do that. You can rely just on the universe of availability from ICAP and CASE, and kind of do that, and that's perfectly acceptable as well. But every advisor on earth uses those. It's not a competitive advantage, and it is kind of limited to the biggest players in the space, which again is not a differentiator because Goldman can offer that. UBS they all use this, so you're not getting anything everybody else doesn't also have. And alts are one of those things that require a lot of educational upfront and a lot of partnership and support. So most of the bigger firms don't necessarily have that partnership approach. And the universe of alts is massive. 80% of what happens in the capital markets happens outside of public, of public space. So that's your alt universe. And so there are smaller boutique firms that are more dedicated to advisors, can offer a level of handholding and support that some of the bigger firms can't. So how do you get access to those? That's where firms like my own come in and can provide access to those boutiques. Because the reality is the way you find these ideas is you have to go looking for them, which means you have to attend capital introduction conferences. You have to go to the big alts events like iConnections and SALT, and you got to just take meetings and do speed dating, do 40, 50 meetings in 3 days and speed date. And I don't know that that's the best use of a wealth manager's time.
Right. I hear you.
So when it comes to diligencing, I recommend that unless you have a team that is specifically expertise in this space that you can dedicate to doing due diligence, your best bet is to look for providers who can do it for you, like what we do.
So you've got your hand on the pulse in this space. What excites you? What's the road less traveled? What's next? What are exciting opportunities, areas, asset classes that you're exploring that are being explored more? I'd really like to get into that with you.
All right. So if you open up any financial publication this morning, or you watched CNBC yesterday, or today, the headlines, the top headline is that the NFL approved for LPs of private equity funds to be able to invest in NFL teams.
Oh man.
So
that's huge.
I would, so the NFL interestingly is very much limiting. Like they only are approving 10 firms. They can only take up to a 10% stake. And here's the kicker. The NFL wants a piece of the carry.
Okay.
Which I think is such a slick move on behalf of the NFL. That tells me that the people that are making the decision understand the marketplace. They understand private equity, which shouldn't surprise you. Many NFL owners have a background in PE.
Sure.
And so they want a piece of the carry, which is quite interesting. That idea of the sports rights is one of the most exciting areas of opportunity I'm seeing today. And its availability to the average investor is there. So sports is a massive like field of opportunity. You know, we talked about the universe vaults being a massive. Well, sports can be team. It can be events. It can be sponsorship. It can be debt. A lot of people don't realize that banks don't lend to professional sports because unlike normal investments where you want to invest in something that's profitable and making money and growing, in sports, the value of your franchise is based entirely on you winning. And you don't win unless you spend as much money as humanly possible. It's like a good owner is spending and not worrying about profiting because the value of the franchise is based on how many championships you win and merchandising and licensing and things of that nature, not on, being able to turn a profit. So it's a different animal. And for that reason, banks don't really like it so much.
No, I imagine they don't.
So you got to look to alternative places for debt. So Avenue Capital has a debt aspect of it, but there are other ways you can do that. So these are some examples of all the different flavors of sports that you can invest in. So that's really exciting. And we are seeing, as I noted, a lot more interval funds in the venture capital space, which is really interesting. Sweater VC is one of the first ones that came out, but you're seeing folks like Social Leverage come out with their own products in that space. So that's really interesting. And then one of the things I talk about a lot, which I think people are now starting to think about in the wealth management space specifically, is that as advisors look for ways to differentiate themselves and get to know their clients better, alts are an amazing tool to do that.
Sure.
I recently read somewhere that 80% of advisors' clients in a survey said that they did not feel that their advisor knew them and that they had no loyalty to that advisor. So it wouldn't take much to get that client to move business-wise. So when you think about it as an advisor, like what are ways that you can use that can grow your business, get more assets under management, also help you get to know your client? And I would argue that alternatives are the perfect segue because you can invest in ways that align with things that you think are cool, that you're passionate about, or that align with your values, like the things that are important to you from a value standpoint.
Absolutely.
Right?
And your NFL conversation, right? I mean, you talk about a slam dunk with a sports fan. Right. Oh, well, hey, work with me. Here's some things we can do together. And sure, it's not going to be 40% of your portfolio, but the fact is you're still involved and engaged in that. It's exciting. You like it. It hits your heart.
Yes.
That's the lineup.
You found out your client is a Boston Celtics fan. Yeah. And now you put that in there. You find out they like certain types of wine. Like now you're actually you're getting investments that get them excited. And in turn, you're learning personal information about that client. And now that client feels like you know them and you're trying to get to know them. You're learning about what's important to them. And I think that that's, a really interesting value proposition. And I think ultimately, this is the way advisors should approach alts as a stepping stone to building and growing and deepening client relationships, finding ways to get clients excited about investing in things that are relatively illiquid. In the sports case, like you said, it's a slam dunk. And I guarantee you, your massive sports fan who's doing fantasy football on the weekends could care less that it's illiquid. And even in the case of absolutely needing money, that would be the last thing they sold because then they can't brag to their buddies that they have a minority ownership and, the Boston Celtics. For the ego alone, they're going to stick with that investment.
It is true.
And they're not going to give you, it's not going to be something that you're talking about all the time because to them, there's a little bit of ego involved.
Well, and then you think sports market, the one tiny sliver of all this, but you could then parallel that into finding a way to leverage NIL rights for college. You could really make this niche, and I wouldn't be surprised if 10 years from now, if we sat down and I said, I love University of Alabama football. And you'd be like, do you? let's talk about how that could be a piece of the portfolio, right?
But you can take it even a step further.
Oh, sure.
So one of the things that I do is every time we sit down to talk to an asset manager that wants to partner with us, my brain starts thinking about like, how do I position this in a way to make these connections? So we have a firm on our platform called Meriwether Group Capital.
Okay.
They're a lower middle market direct lender. They provide capital to small business owners, typical loan size between $1 and $3 million. So they're fitting a need that's like a lot of these businesses, the banks aren't going to lend to.
They're fitting a very good need, quick need, capital need. Yep.
And where there's a lot of demand. Because there's more small businesses in this country than these big businesses.
Absolutely.
And the vast majority of people are employed by small business. So this is a need. They tend to stay out of the tech space and serve everything else. So Meriwether Group Capital funds called the Hero Fund, heroes meaning small business owners.
Yeah, I get it. That's
And
clever.
if I'm an advisor who has a lot of small business owner clients, that's going to resonate with them.
It is. It would also be a bit of a hedge.
Right.
I mean, like a true hedge, right? Because I'm going to have assets in this organization where if I do have to lend, not necessarily from them, but you get the idea, I'm lending from a similar crew, right? So you really do play a hedge on that, as well as passion and as well as values.
Yeah. And we have another firm called Web Street that does micro private equity investments, fractional ownership, and e-commerce businesses. If you are an advisor who deals with a lot of folks who have small e-commerce businesses, Instagram stores and things of that nature, that's going to appeal to them. And you have sports, there's wine funds. If you have a client that's a wine aficionado, there's Masterworks, that's art.
Oh, yeah.
Like InvestBev is like whiskey and tequila. Like I can go on and on. We talked to a firm, Hudson Investing, that does horse racing.
Okay.
I don't know if you're into horses.
But if you are.
And then you can take it a step further. We're talking ego stuff. We're talking stuff where people are like passionate about on an ego level and connect with on that level. But then there's also the ability to invest in things that make the world a better place. So microfinance for small female entrepreneurs.
Sure.
Looking at things like real estate firms that are doing a portion of development in workforce housing, right? Or rehab of historic buildings. I once diligenced a fund that completely redeveloped public housing facility in South Bend with a co-invest from the municipality of South Bend, right?
Sure.
And why is this great? Well, they rehabbed the entire, it was basically projects, low-income housing. They added services, so they added free universal Wi-Fi, and they built a little library and for kids to study, and they brought tutors on site, and they rehabbed all of the apartments so they were, completely refreshed. And you know what happened? Crime went down.
Of course it did.
Because people...
There's no question it did. Right?
Yeah.
I was having a conversation today with Jack Campbell and her crew about, we talk about opportunity zone investing.
So Jack is one of our advisors. She works with us.
So we talk about opportunity zone investing. When I talk about it with land guys, right? It's very it's very, I don't know, esoteric, right? I've got this piece of property. I'm going to do this opportunity zone. Then the tax basis goes up, reinvesting. But when you have a conversation about, no, this is what Opportunity Zone in Detroit did. This is Detroit before and this is Detroit after. It gives you, just like you were saying, right? It gives you a real tangible, like, there's more than just the tax value of this. You've changed lives and community.
Exactly.
And then if you can get your client, like you were saying earlier, on board with your value set, and this is what's passionate to me, that client will not leave you. You're not going to be one of those 80%.
Exactly. And that's the thing. Advisors do want to have tax efficient vehicles.
Sure.
So oil and gas is a great one, right?
Yes.
So there are a couple drilling funds that have approached us wanting to be on our platform. Oil and gas drilling, that's a cash flow business, and the tax benefit has to do with depreciation of the underlying asset. So it's actually a little bit hard to price and things of that nature because it's depreciating.
It can be hard to value, yeah.
Yeah, absolutely. So it has some complexity to it. But if you live in Texas, I swear to God, everybody in Texas wants to invest in oil and gas.
Wrong. You're not wrong. And they also realize the boom and bust of it.
Right. But if you're an advisor in Texas, that's going to resonate with your client base.
It is.
But if you're an advisor in, say, Massachusetts or Illinois, where we are today, the tax aspects, and the cash flow aspects might be more attractive. There's so many different ways you can kind of think about it, but I always think that the best way to start is to make the connection with something on a personal level. And I would argue you could probably do that with almost anything if you think about it the right way. And the alternative space is really the only place you can do it, because everybody and their mother can offer you Vanguard.
Yep.
Everybody and the mother can get you into KKR.
Sure.
So how do you find other things that your clients will get excited about? You got to go looking for them. And that is what we at Banríon seek to do to help advisors. And even though we do have some very traditional stuff, things like middle market direct lending with Meriwether, but again, small business, there's always a way to kind of find a way to make it connect with your client.
I would say find a way to make it connect. And at the same time, you're getting all the quant that goes with having alts in a portfolio, but you're also getting the benefit of value connection on top of that quant diversification, right? So, I mean, you're providing the products that don't go hand in hand with target date funds in the S&P that everybody's in their retirement accounts. And at the same time, you're building value. I think that's extremely exciting. There's another question I want to ask you. Are we start to see more crowdfunding direct to consumer alts? I think you lose something in having a skilled financial intermediary talk you through those conversations if you're just buying directly. Right. But where have you seen alts in that direct to consumer space? Is that something y'all have investigated, looked at? Have you seen trends in that way?
Well, Sweater VC is one of those direct to consumers. You obviously have crowdfunding, things like InvestX. You have, who did I talk about? The CrowdRise, Startup Engine, all the lending clubs.
All the lending clubs.
Things of that nature. I would suggest, and one of the reasons why none of those things have ever really blown up per se is because they're still attracting the same ultra high net worth investors that have advisors. As an advisor, you're missing out on the opportunity to be able to build on those assets by not opening up your mind to those ideas. Because to your point, those clients are investing in them anyways. They're doing the angel investing and things of that nature. It's in your best interest to make yourself available to the client. The client's already your client. They're already paying you. Now you're just offering them an additional service by being able to provide them with diligence and things of that nature. And I think that clients would find that valuable.
Yeah, absolutely. And in closing, this has been a great conversation with you, but I'd like to give you a platform here for a few minutes.
Okay.
A lot of our audience, we have a fair amount of, really skilled insurance agents. We have a fair amount of CFP professionals, RIAs. We have a fair amount of land professionals and then land brokerage listening too. But how would you give that market advice on alts? I want to learn more. Where do I go next? How should I educate myself? I'd love to get your take on that.
Well, there's a lot of places you can go. I'm a shameless self-promoter. Banríon has great content. We have 2 podcasts, The Alternative Mason and What's the Alternative? And then we have a web series. I'm due for an episode called You're Doing It Alt Wrong, where we take on myths and misconceptions related to alternatives. They're like 5-7 minute videos. You can go to Investopedia. That's an excellent resource. I recommend, if you don't want to go all in and get your Kaya like I have, which is on par with having a CFA, and it's very complicated and multi-layered test, and it's very hard. The Kaya Association offers something called the Fundamentals of Alternative Investments program. Yeah. And shameless plug, I wrote 2 of the modules, and I'm actually in the curriculum. There's a video of me talking about some of the curriculum. That certificate is extremely affordable, and it's a great foundational learning opportunity. I love it. If you want to learn, I think it's like $1,000 for the program, and you get all the modules and the certificate at the end, and you finish it and feel confident that you have a good baseline knowledge. And there's other ways you can consume. So our friends over at the Wealth Channel have a great podcast called the Alternative Investment Podcast. You have TED CDs with capital allocators. You have Ernest Sweat with swimming with allocators. There's a number of great podcasts that are focused on alternatives that are easy to listen to, that I highly recommend, that can be very educational. Simplify Asset Management has a great podcast. It's all about teaching alternatives. And so there's a number of resources if you're into podcasts and things of that nature. But I think that if you're interested in learning more, the first step would be to look to find a platform like Banríon that can provide you the resources you need to educate yourself and your clients, and then also be able to be accessible to you, advisor, with your questions. But one thing we didn't talk about, and I'm going to get on my high horse for a minute and a half here, is the reason 70% of advisors don't invest in alternatives, yes, has something to do with education and diligence and so on. But a good chunk of the reason they don't invest in alternatives is because it's operationally difficult.
Yes.
It's difficult to bill on. It's difficult to oversee because once you make the investment, you're not the LP, the client is.
It's difficult to get your custodian on board sometimes.
Yeah, it's difficult to put into your consolidated performance reporting. There are a number of solutions out there that seek to solve parts of that equation, but none that solves them all in one nice, tidy little put it in a bow kind of thing. When I launched Banríon, I was coming off a period of time where I was consulting for advisors on building alt platforms, and I was trying to put together a tech stack that worked to efficiently do it. And one of my frustrations is I needed 4 different things or more, and it still required some manual reconciliation and issues of that nature to make it work. So when I launched Banríon, the whole point was I love the due diligence. I love going out and finding managers, the education, thinking about how to market it and helping advisors figure out how to use it for business development. But I also knew that if this was going to be really a game changer, I had to have the solution for the workflows, the compliance, operationally making it feasible.
And without
easy.
multiple platforms, multiple entries.
Exactly.
Yes.
So we partner with a firm called Mammoth Technology to build out custom investor portals, white labeled portals. So it's your URL slug. And it is your clients, and your clients have their own portal, and you have your own portal, and you can make investments directly through the portal. And then everything's auto reconciled. We can stand up SPVs for you. We can do due diligence on demand. We can set up your own libraries if you've already done diligence on stuff and want to have it there, so on and so forth. But what we sought to do was remove all the friction from the process so that you could be part of the entire transaction from start to finish, from making the actual investment to overseeing the investment. And so by partnering with Mammoth, we have created this solution that we think solves all the friction in the process in one technology solution, as opposed to having to piece together multiple solutions and hope that it addresses your need.
That's absolutely where advisor space is in public markets and in mutual funds, right? Is we've eliminated the swivel between monitors and between chairs. And so to have that in the alt space is absolutely refreshing and very innovative. Yeah,
so that's what we're doing. So if, advisors, if you're out there, call us. We'll show you a demo. Again, I'm shameless. But yeah, so I think that, we can talk alts all day long, but if you can't make it easy for an advisor to operationally make the investment and monitor the investment, then everything else we talked about in this episode is for naught. They're still not going to do it. So the good news is I think people are recognizing this. I think firms like Banríon are here for you, advisor, to find interesting boutique ideas that will help you stand out from the crowd, help you get to know your client, and be able to make investments in a really operationally efficient way.
Well, thank you so much for your time today, Shana. We will link in the show notes all sorts of goodies. All right, thanks.
Thank you.